offensive selling is something that investors should really be thinking about right now to add to their toolkit. Selling is just so important.
I agree. I think having a strategy to exit individual stock is of utmost importance. Whether you're going to sell offensively, defensively, however, a lot of it is personality based, I think, the type of trader you are / investor, but it's an absolute must. And most people don't think about it. It's not as fun as buying. When you buy something, you're super excited. It's going to go up a ton, and you have all these great dreams of how much you're going to make on it. But selling is like, that's it. That's the end. I can't make any more money if I sell it at that very moment. So
Yeah.
I think most people don't think about selling enough.
Protecting your profits, especially in the environment that we're in. So knowing your personality as a trader, that's important. And I also think knowing what type of market you're in. You may be positioned a little bit differently, quicker to act on the selling front. So there's a little bit of a ripple effect with that. And then also I think taking a step back with selling, good traders know, active investors know that you have to cut your losses at a certain point. Have a rule for that to make sure that a bad trade doesn't turn into a huge mistake. But as you're saying, Scott, I think it's even better traders who are really dialed in on that profit-taking side, because that is so tricky.
Yeah, it is hard because, most of the time, if you sell something that's gone up, there's a reason it's gone up. Either the market's good, the company's good, or probably both. And I always say, why should the stock stop going up just because I sold it? I wish it would. It would get rid of that, that FOMO factor that we all have because we sell it and it keeps going up. I find that tends to happen almost always if I'm selling something on the way up. But then I look back 3, 6, 9 months later, and a lot of times, wow, that turned out to be a very good sell, even though initially it did continue higher.
Yeah,
that's the hard part about selling into strength, is because everybody wants to sell near the high. If only it were that easy.
Yeah, that's such a good point. And so we have an inside joke, Scott, with you on IBD Live. So those in our audience who tune into that are familiar. But you always like to say, "Sell when the ducks are quacking." So, you are so good at selling into that strength before you start seeing those signs of weakness. So why don't you talk a little bit about that strategy and why that is something that you lean on so much?
Well, first of all, I'd love to take credit for the quote, but like every quote I've ever given, I've taken it from somebody else. So I don't know who invented that quote. I think it came from the CBOE. I actually tried to figure out, where did this quote come from?
Where did it originate?
Somebody said that. In essence, it means when things are good, you want to do some selling. So I just found, I don't know, profits are slippery. They're like eels. You have them, and then you look back and they're gone. And so. I just found that for me, I don't know if it's just the way I trade or the strategy or whatever, but I just found I was always better off taking some of the profits, maybe not take all of them. I've actually tried to be better at that, rather all or none, but I am almost always, Ali, if I have something that's working in my favor, I'm doing some selling into that strength, because they just tend to get away. Most stocks aren't there. There are very few Nvidias and Googles and Teslas, and we're all striving to buy it and watch it go up tenfold. It's every trader's dream, but it's really hard. That's a very difficult process to capture.
It is. So, in this webinar today, we will be going over some various examples, whether it is holding a stock for a bigger move and then recognizing when the tide has started to shift a bit, what you should do in that scenario. Also, for even new buys, when should you be really quick on the trigger? So a lot of different scenarios that we want to talk to and then get specific with some actionable takeaways for rules and tips that investors out there can start adding to their trading toolbox. So you mentioned Nvidia, so why don't we go there? I'm showing a weekly chart here. And as we know, NVIDIA had this amazing move coming out of the 2020 coronavirus crash, built a cup with handle base, and then that launched a big move. But it did take some time off in the September 2020 to May 2021 area before continuing on its move. And Jojo, my dog, is very excited about this discussion. But at some point, the environment changed for a lot of tech and software and chip stocks. And now NVIDIA, after going as high as almost 350 in late November 2021, is back below 160 and right around the levels it was trading at in over a year ago, Scott. So walk us through, talk to us about some of the selling strategies, selling into strength. Say you got in NVIDIA back in April 2020. How should investors be approaching this from a selling standpoint?
So there's two ways. If you're trying to really capture a big win, then I think you want to use one of those two moving averages that you see on the chart. The red one, which is the 10-week moving average, and then the black one, which is 40-week moving average. So if you're really trying to capture a big gain, you get ahead on something, then maybe you want to use that 40-week. The problem with the 40-week is by the time you get that signal, it's going to be significantly off the highs, 25, 35%. And it's going to be hard for you to sell psychologically because you're going to have that regret. I should have sold it at 300. I'll sell it when it gets back there, right? I've heard that 100 times as a stockbroker in my early days. I should have sold it at 200 and now it's 150. I'll sell it when it gets back to 200. And the drill there. They rarely get back there. So if you have to understand your plan and know that you're not going to get the high. And so when it breaks that 40-week line, then you've reached the signal, and then you're out. You're out at let's say 230 or 240, or even 210, which is 60 points from where it is now. The other strategy is sell it while the going is good, rather ducks are quacking. And there's a lot of tools you could use, like an upper channel line sticks out like a sore thumb for me on Tesla. I'm sorry, on Nvidia. If you
maybe we'll look at Tesla
there you
too.
go. That line right there, exactly. So you can.
So for those listening who aren't watching live and they're listening to the recording, we've connected the highs of NVIDIA from April 2021. You can connect that to July of 2021, late August of 2021, and then in November 2021, it goes above that channel line, Scott.
Yeah. So a lot of stocks have personalities. They have natural rhythms to the way they trade. Some are more volatile, some are less volatile. So once a stock starts to do something unusual, you need to heed that signal, whether it's unusually positive in NVIDIA's case or the other way around. But you can see how it has a natural rhythm. It goes up, it pulls back, it goes up, it pulls back. But then that last go up, goes from 200 to 350 in 2, 4, 6 weeks. That's NVIDIA is a massive company. As we sit here, it's almost 400 billion. So that's for a stock to go up 50% in 7 weeks is an unusually positive, strong move. And and after already having made a big move, right? It's not like Nvidia's coming out of this long period where they've gone sideways for a long time. So, it's easier in hindsight. That's why you should study these charts. So the next time you have XYZ and it exhibits these characteristics, you'll be more apt to say, I know that this tends to lead to some kind of pullback. Maybe I ought to do some selling into this. But that was a great time to do selling into that unusual strength, 50% in 7 weeks on the largest semiconductor company in the world. I'm assuming they're the largest. They might not be, but they're one of, yeah, for sure. And definitely the leader, right? And that's an offensive sell signal for sure.
It is. So you can create these channel lines. There's a little bit of an art and a science to it, but you want to be connecting at least 3 points in the prior couple of months. And if you see the price move above that channel line, that is, as you said, an offensive sell signal. And then it comes down to, okay, well, how much of my position? Say 10% of my portfolio is in Nvidia. At that time, should I be selling all of it? I'd imagine in real time, and this is where the approach that you have is so fascinating, because I feel like the gut instinct, that the emotional side, that greed, is things are going so great, I want to make even more money. Why sell here? But there are so many instances that have shown that at least taking some off the table, as you said, while the getting's good, is a very sound strategy.
Yeah, it's a lot of art. Unfortunately, there's no perfect answer. I like to do things in increments. That way I don't have this all or none fear of making a mistake, right? So let's say I have 1,000 shares and I sell 300 at 250, and a week later it's 270. Well, I would love to have those 300 shares back, of course, but I still have 700, so I'm still doing just fine. And then maybe I'll go from 700 to 400. 400 to 200, or sometimes it's usually about 3 trades that would get me out on the way up if I was doing that. And most of the time, the nice thing about doing some selling is it gives you an anchoring point. So we're all human. We anchor to prices. We know what we paid for something. So you can anchor to that price, use that in your favor. So if I sell some at 250, I'm going to remember that sell. And if it's 255, 260, 270, well, that's a bad sell, right? I wish I hadn't done that. So I've gotten feedback that maybe the stock is doing okay, and I can leave it. Let's say I take off another 200 at $300 a share, and now it's 290, 280, 270. It's like, whoa, that was a really good sell at 300. Maybe I ought to do more selling, since that turned out to be such a good sell. So you can give yourself these kind of anchor points along the way if you have a hard time selling. Most people I talk to, the feedback I get is, I was up X amount in ABC and I gave it all back. I hear that a lot, from people, because everybody wants to capture that really big winner. And it's, of course, I would love to too. I just find that it's not as easy as it seems after the fact, because I've been in all of them, Allie, and I've been, and I remember how strong and great Yahoo was, and I was, in Yahoo for bits and pieces along the way, and ultimately it never came back. And then Google comes around, and Google has, I probably thought, well, Google will do the same thing as Yahoo, but it hasn't. It's just powered and powered and powered. So, and that was the one to keep. Yahoo was the one to sell, but I don't know. I don't know how you would know that in real time for sure. So, once in a while, I think the best strategy might be, if you have 10 stocks, you're an offensive seller on 8 of them. and then just pick the two that you really love. I think it's Tesla, Apple, Google, XYZ Pharmaceuticals is the next great one. And I'm not going to take, 20, 25, 30% profit in this one, and try to make it work. And if you get that once in a while, let's say every 18 months, you stumble into an Nvidia or a Google or a Tesla or Square, it can really move the needle on your portfolio. But some of them you're going to have to be willing to give back all of the gains if you're going to do that. So you have to remember, I'm not going to get all of them right. If I pick 2 out of 10, I just hope I get one of those. Maybe one is Square and one is PayPal, and PayPal gives back all the gains, but Square doesn't. This is stuff I think about a lot, and there is no perfect strategy. I wish there was. Hopefully I'd stumble upon it, but you really want to think about how, that type of strategy, something that would fit, and you have to believe in it, so that when the time comes, you say, you know what, that was my strategy to sell that into strength. I'm going to do that. Or is like for myself, it's really hard to not want to take those profits. I have to say, Scott, you told yourself that XYZ was the one you're going to try to keep for a big win. And, follow the rules, follow the plan you have, and give it a chance.
Right. Because with a Square or a PayPal, I think at some point, even if you're giving the trade a lot of room and trying to hold it for a big win, you have to have a point at which you are going to get out. Maybe your profits have diminished, you're not selling at the top, but would you really want to give back an entire huge move like for Square here? Coming out of the COVID crash, it was around 60 or so, made it all the way up to just shy of 300, and it is now back below 60. So I think even if you have those, big name brands that we're all so familiar with as game changers, at some point you have to look at the chart instead of just think, because these are questions that I see too, is okay, well, give me your 5-year price target on Google or on Square, and hey, it's really cheap right now. So if the next 5 years could be very positive for the stock, then why not get in at these levels? So I know this is more kind of a buying thing or a reason to hold, but I think that also impacts the selling side as well.
Yeah, I would never do that, Allie. I've never been anything down 50% off the highs, at least not on purpose. It happened to me one time where, a company pre-announced or the earnings were bad and the stock was down 50% in one day. There's nothing I can do about that. But you're right. I would be a seller. If you look at history, there are very few Apples and Googles and Amazons. And the other thing is you can always buy it back. I mean, there's no rule that says I bought Yahoo at 20 and sold it at 30, therefore I cannot buy it at 35. It's strong ego, weak judgment. If you refuse to buy something at a higher price that you think that your setup says is going higher, I have no problem buying stocks at much higher prices than I ever sold them before, if I think the setup is there for it to go higher. So that will help alleviate a little bit of that selling fear as well. Is, you know what, you can buy it again. It's it's always available to you. The problem is once they break like Square has, the math is cruel. The math goes against you. For Square to get back to 250, let's say, which is sort of within a stone's throw of new highs, how much does it have to go up? Almost 400%. It almost has to quadruple, maybe 350. So how many stocks go up 400%, 300%? Those are the gems in the stock market. So once they break, it's just really very difficult for them to come back, because you have a lot of overhead supply, a lot of people are stuck at higher prices. So every time Square tries to go up, there's somebody out there that's just glad to get out near even. And remember, the stock market's it has a rhythm to the earnings and sales of these companies. So they're not breaking this poorly just because. A lot of times the market is anticipating changes in their business, disruption in their business, earnings slow down, and that can go on for a long, long time. So you might be stuck in something that goes sideways forever, best case, and then you have what we'd call dead money. So if Square goes between 50 and 60 for the next 10 years, that's money that you could have in another name potentially that goes from 50 to 80 or 50 to 100 or something.
Yeah, a big opportunity cost there. All right, so Scott, we talked about a lot of different sell rules for handling big multi-year winners. And now I want to talk to you about something maybe a little bit more on the short-term trade side. So this year we've seen a lot of oil and gas stocks making big moves. So we have this backdrop of a stock market correction. And all of 2022, it seems though, underneath the surface, there have been select opportunities in a lot of commodity related names and especially oil and gas. But I'm going to pull up FLNG. This is an LNG play, and this is a stock that you recently traded, as did I, full disclosure. And it hasn't been the smoothest ride up, but I feel like this stock is a great example on multiple fronts, where knowing what type of environment you're in, even if you're trading stocks in leading groups, feeling comfortable with taking quick profits, and how where you enter a stock can have a huge impact on where it is you're selling.
Yeah, you see, this stock has, in the short term here, it had a natural rhythm, right? It tended to live around that 50-day line, that red line. And so I was a seller into strength, and then I would buy it at or near the red line, and of course it doesn't work that perfectly. Sometimes you might get in a little early, or it will just kind of wear you out a little bit, but it just has a natural rhythm. So that's something that I noticed. And so I would trade it accordingly, based on that, buy it at or near that red line. And, if it runs up 10, 15, 20%, something like that, then I'm going to take it off. If I had 10 stocks, like I talked about, this would be one of the 8. I'm looking to sell those 8 offensively into some short-term strength.
So I have a trend line drawn on this chart, because not only can we draw trend lines to signal a break of an upper channel line, but we also use declining tops trend lines to identify potential buy points for a stock. So the team identified one such buy point on June 2nd when it cleared a declining tops trend line, also coincided with a heavy volume move, rebounding off of that 50-day line, the red line, as you said, Scott. So a potential buying opportunity there. But 2 days later, you were selling the stock. So that's a quick move, just 2 days later. And maybe you were even, I don't know, were you taking some initial profits off by the end of that day on June 2nd as well?
No, it's not enough of a move, but I sold in thirds, but all 3 sales occurred on the same day. So I sold it, and then it got, stronger, and sold it. And then, when it ultimately was up, I don't know, I think it was up like 15% on the day. I just know it's not sustainable. That, that's, it's going to come in most likely based on the rhythm. There's going to be a time where it comes into that 50-day again. Now, my I didn't know it was going to do like it did, break immediately. I thought it would come in naturally to the 50-day over a number of weeks, like it has. but it didn't. It broke. I think there was some natural gas news that
Right.
caused the stock to break, and then hasn't come back yet. And now it looks like that rhythm is broken. That the personality of the stock has changed.
Mm-hmm. And so some people who are familiar with patterns to buy stocks, might recognize this as the day that you sold as a day in a bull market, perhaps as a day to buy. It's getting to new high ground, clearing a prior high. But knowing what type of market you're in can mean having a tighter leash, and going with an earlier entry makes all the difference of selling, having a profit and selling into strength where you sold. Or if you waited to buy at that point, then you would have had to use a defensive sell rule of, taking a loss of up to 7 or 8%.
Yeah. So you have to remember, though, it's breaking out after being up 26% in 4 days.
Right.
So I'm always thinking, that doesn't mean it can't continue, but everything is probabilities, and you want to just kind of put the odds in your favor as best you can, because this is an imperfect science. We're doing the best we can with the information we have. So I just think 26% in 4 days, that's enough for me. Like, imagine you held a stock XYZ, for 6 months, and it went up 26%. You'd be pretty excited about that. That'd be a pretty good trade. So, I don't have this intention that I'm going to hold it for 4 days. I hold it as long as it's acting well and hasn't reached either one of my targets, whether it's my upside target or my downside target. And if it happens in 4 days or 4 weeks or 4 months, once it reaches my upside target, I'm gonna do some selling. So now you have to, some people don't like to be that active. That's fine. There are stocks that I've sold like this and got lucky on the, sold within moments of the high. But there's, we could scour this database for sure for stocks that I sold like that kept on going. And I'm okay with that. I live with it. You're not going to get it perfect. Some I'm going to sell too soon. Some are going to keep going. But I'm going to just keep doing that over and over and over, rinse and repeat, rather than what I find most people are going to they're going to cherry pick it. This one I won't sell. This one I will. And I don't know how the stock market knows, but it knows. It knows which ones you keep. It knows which ones you sold. And it's kind of like sitting through earnings.
Yeah.
I'm going to sell XYZ because of earnings, but I'll keep ABC, and the drill. XYZ goes up and ABC goes down, and you're just scratching your head. So I think you have a set strategy, and you just do it. You just live with it. And, and maybe as you go along and study and see how things are going, you can tweak your strategy a little bit. You don't have to, be set in stone. The market's ever changing. The market's really fluid. And every time I think that, I have this down, the market will change course a little bit, and you have to learn to kind of change with it.
Yeah, and for me, I've realized, and it seems simple, but it's kind of one of those, you got to burn your hand on the stove to know it, like a lot of these rules are. But the pain of suffering a loss is a lot worse than selling too early and feeling like you missed out on an even bigger move. So I totally agree with you on taking a little bit of that profit, even if you're looking at it and you feel like maybe it's too early in the move, before you see those signs of weakness, go ahead and lock some of that profit in, because that's a whole lot better than round tripping a considerable gain. Like someone in the Q&A, Gabriel, is asking us about Exxon Mobil. So going along with this oil and gas theme, this is a stock that had a nice move higher in the last couple of weeks, going from about 83 to, let's see here, about 106. And it's given almost all of that back, Scott.
Yeah, and if you look at Exxon on a weekly chart, you see it's like, think about it. Where was Exxon in the cycle of this move, right? It was later on in the move. It's not exactly
Right.
the beginning. So, Exxon's gone from 30 to 100. This is Exxon. It's a massive, huge company. So when, knowing that it's made a big move already, excuse me, if I was buying that breakout, I think there's nothing wrong with buying that breakout through 90 or whatever, but I would be a seller into that strength. Or the very first time you get weakness, you need to cut bait and run. So when it gaps down from 100 to 95 in one day, your objective wasn't to make 5 points. Let's say you bought it at 90, but the market's giving you the signal that this might be the only 5 points in this trade before it becomes a 5-point loss. So take that 5 points while you can.
Mm-hmm.
That's you're just kind of reading the tea leaves, going along with the market, with the signals it's giving you, slowly but surely, day by day.
Yeah, something that we're monitoring. It is this a base building period for many of the oil and gas names, or has this move been exhausted? And now, we're seeing signs that a number of them are rolling over. And Amira is asking us about the XLE ETF, which is a proxy for this move in energy stocks with heavy weightings in Chevron and Exxon, of course, but a big down week this week, down 17%. Amira is saying that they've held it for a number of years. In our style, we would have been looking at this, and we were looking at this in early January. Speaking of a declining tops trend line, as I mentioned earlier, connecting some of those highs. We saw a big blast out of that the week of January 7th, and a big move since, holding the red line, which you mentioned, Scott, which is the 10-week line on our weekly chart, 50-day line on a daily chart. So talk to us about some of the offensive sell rules that one could have used if you did get into XLE that first week of January.
Yes, it's not as strong a channel line as Nvidia, but there is a bit of a channel line. And sometimes there's the sentiment out there. You can kind of feel and get it. I like to use sentiment a little bit to tell me like where people are positioned, of course. And with the way tech stocks were, a lot of people have been positioned looking for higher prices in oil. And there was a day, I should have pulled up the tweet. I tweeted where oil was up a lot, the commodity oil, and the oil stocks were not. And these are subtle clues that the oil stocks were tired and probably needed to be sold. So that was, there's little stuff like that. This wasn't as clean a sell signal from an offensive standpoint, but you've got your first defensive one. This is a pretty hard break of that 10-week line. If I can't remember the person's name, I apologize, but if they've held it for years and years and years, they've really held it through thick and thin. And so, maybe now is a great time to explore, having some type of rule. I would use the 40-week line. So if you go back to that weekly chart, look at the 40-week line back in 2019, and look at how the stock is just like a total ceiling, right? This ETF could not get above that line. Nothing good happens below the 40-week line. It's like your mom used to tell you when you were a kid, be home by 1, right? Well, why did you have to be home by 1 or whatever, right? Because nothing good happens after 1 a.m., right? So this is the stock market. In stocks, nothing good happens below that 40-week line. You want to be out of stocks below that line. So you could have been out of it below that line and waited it out. You missed the whole move down in COVID in March 2020 when this broke really badly. And then once it jumped back above that line, there you go. Now, if you really want this type of exposure, now it's back above the line, and on a closing basis, really let it show you. You're not going to catch the low. In hindsight, it would have been great to buy it at 25, but there's nothing wrong with a buy at 40. You almost had a double in an ETF. That's a really great move. So if you're going to try to hold things for a long, long time and you just don't have any sell signals, I would say if you take anything away from this today, Ali, is use that 40-week line. That'll keep you out of all the major bear markets, all the ones that really do the damage. And it should help you stay the course in any mini corrections or stuff, because most stocks are not going to break below a 40-week moving average in just a mini normal correction.
Right. That's a really good point. And one thing that I would add to that is ideally you're using that as a sell signal once you have attained a very solid profit cushion. It goes back to, one of the first examples that we used with Nvidia. Looking at the 10-week moving average is a great sell signal that we like using for leading stocks that have made big moves. But say you buy a stock and it immediately falls 20-30% but it's holding above its 200-day. So it's just a little bit of a clarification.
Yes, this is for the people that want to capture the really big moves, the stocks that go up 2, 3, 4, 500%.
Absolutely.
If you're trying to do that, then you use the 40-week line. The problem with that strategy, because I've been trying it for years and years and years, it's very psychologically difficult, because how many times do you have to be wrong before you get that one that's right? Now, the math is in your favor. If I'm wrong 5% on 10 names, but I get the 11th one right and it goes up 200%, and I'm using proper money management, let's say I lost 50%, 5%, 10 times, but I made 200% on XYZ, I finally got that great winner. Well, I'm net 150. You get the idea, using proper money management. But I don't know how many people can be wrong 19 out of 20 times. It takes a very strong psychological person to do that. And most people who come into the stock game, if they haven't been doing it forever, they're usually very successful in their life. If you're a doctor or a lawyer, you're going to have a hard time staying in business if you're wrong 19 out of 20 times. Or an engineer that's building bridges, you are right all the time. These people are. And the stock market's just a different psychological animal. It takes some getting used to. A lot of getting used to. Even me, 25 years of doing it. And I find myself fighting that urge to follow a rule sometimes,
Yeah, but I think that's what it comes down to is, part of the issue is that you find a stock that you like, or say you've researched it. You can have all of the reasons in the world that this is a good thesis that you have. But if you're not looking at charts and relying on some rules, it's not good enough to spend, unfortunately, to spend all of that time researching for the many reasons that you outlined, just the odds. So if you want to hold a long-term winner, I think you have to balance that with knowing that, yes, in the long run, the stock market broadly, the broad market does go up. But if you are trying to apply that to individual stocks, a handful of them, and having heavy weightings in those, I feel like that's a misapplication of that data point there.
I agree. William O'Neill, they had a database going back 100 years of the greatest stock market winners. And it's littered with stocks that have gone down 80%, not come back. So in the
There's a
math,
time and a place.
yeah, the math is cruel. I don't care how much it goes up. It could go up 500%. If it comes down 80%, you've given back all or most of your profits, right? So, yeah, individual
Mhm.
stocks must have some type of sell rule. If you don't want to sell, then buy mutual funds and
Mhm.
just buy low and just buy at any price. And that's what a lot of people do in their 401k, and they've done fantastic doing that, and that's fine. Based on your age, of course, you might have
Right.
to tweak it a little bit, but yeah, in my 401k, I don't know. I don't look at it. I just whatever price is, I just buy. I just buy.
Mhm.
But
Mhm.
for individual stocks, which I'm mostly in, like 90% of, if not more, of my liquid net worth, I use individual stocks, and I
Mhm.
have a sell strategy for every single name, no matter what.
Mhm. Yeah. In closing, from me, we've talked about when it comes to selling into strength, that is so very important to start locking in profits when you have a good gain, because you never want a decent gain to round trip on you or turn into a loss. You can handle long-term winners differently than shorter-term trades, but you have to know your personality as a trader. You have to know the personality of a stock, and you have to know what kind of market you're in, and you have to have rules to help back up your decision making process. Scott, what from you would you say is the biggest takeaway right now from this session today?
Well, I would just tell most people that selling is hard. It's difficult. So don't be so hard on yourself. Like I'm my worst critic. My wife always tells me, "You're too hard on yourself, Scott." Because I want to get it perfect. I want to buy it here and sell it there, and I want to hold the apples and the Googles. And there's a lot of money to be made by not being perfect in the stock market. So don't beat up on yourself. Stay the course. You're going to make mistakes. You just got to keep going and going, and one day there'll be a period where it clicks for you and you'll be like, wow, this is amazing, and then you're hooked. At least my experience is, like, for myself, and that for me was a long time ago, but I've seen it with lots of my friends and colleagues and people that we've come across in IBD. They get it, and then they'll make some mistakes again, and it'll be hard again and difficult again, a lot like the market we're in right now. I'm sure a lot of people are having a difficult time, but this will pass. Maybe not as quick as we'd like, but it will pass. And the people that kind of give up, that aren't there, they won't be there for that next cycle. So that's the other thing about selling, is you want to protect what you have at least a little bit. That way you have ammunition for the next cycle up, and rather
Exactly.
than a bunch of stuff that's beaten up and then hoping in the next cycle it comes back. Because based on history, not all of these stocks are going to come back. The Teladocs, the Shopify's, I don't know which ones, but history says 3 out of 4 of those are not going to come back. There'll be new leadership, new companies coming along, and so you want to have some cash available for those new
Mhm.
opportunities.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.